Hello everyone and welcome back to the channel. This is the place where I break down the principles of value investing to help you invest smarter for the long term. Warren Buffett has often talked about the intrinsic value of a business. He defines it as the discounted value of the cash that can be taken out of a business during its remaining life. What we see on a stock chart every day is simply the price per share. And if you multiply this price per share by the total number of outstanding shares, we get the market cap. That is the price we have to pay to buy the entire company today. But here is the catch. The real value of the business could be very different from that market price. Sometimes it is way more and sometimes it is way less. This difference is called a price disconnect. It happens because the market sometimes misprices stocks due to short-term factors. For example, Wall Street is often obsessed with the next quarter's earnings. If a company misses a short-term estimate, or if they decide to invest heavily in, let's say, capital expenditures, like Alphabet is doing with AI right now, the market panics and dumps the stock. They focus so much on the next 90 days that they misprice the cash flows the business will generate over the next 5 to 10 years. If you know the real value of the business, you can spot when the market has priced it way below its true worth. That gives you a great opportunity to buy at a discount. Over time, as the market realizes the true worth of the business, the price gap fills up and we make a profit. So, if we can estimate the actual value of a stock, our decision of when to buy becomes much simpler. But remember, intrinsic value is not a single precise number. It cannot be. It is actually a range of values. In June of 1996, Warren Buffett published an owner's manual for Berkshire Hathaway shareholders, and there he explains this perfectly. He points out that intrinsic value is always an estimate, not a precise figure. Furthermore, it is a dynamic estimate that must change the moment interest rates move or when our forecasts of future cash flows are revised. Warren Buffett even says that two people looking at the exact same set of facts, even he and his partner Charlie Munger, will almost inevitably come up with at least slightly different intrinsic value figures. So as value investors, we do not need to be precise down to the decimal point. We just need to be directionally right. And when the stock price falls well below that range of values, it offers us a margin of safety. This is the ultimate cushion that protects our capital. In this video, I will show you how to calculate the intrinsic value of a stock in just minutes using the Let's Value Invest platform. Many value investors use complex Excel sheets that involve manually entering data for a given stock. That is how even I started. But with my engineering background, I realized there had to be a simpler, faster way to do this without manual data entry, which is tiring and leaves room for errors. Let's jump into the screen and see how we do this. When we pull up any stock on LVI, we go straight to the valuation tab. You will see a drop-down showing multiple valuation methods. You can choose projections for 5, 7 or 10 years. I always select 5 years of projections. Why? Because projecting a business beyond 5 years starts becoming speculative and unreliable. Next, you can choose the discount rate. This is simply the rate of return you are aiming for. I set this at 10%, which is the historical average return of the market over long periods of time. Below this, you will see several baseline presets. Custom, Analyst projections, historical CAGR, moat and quality adjusted, and finally the reverse DCF. These presets are incredibly helpful. Custom lets you do all the assumptions from scratch. Analyst projections automatically pulls Wall Street growth estimates. Historical CAGR aligns the assumptions with the company's past performance. Moat and quality adjusted applies premiums to high quality and wide moat companies. And reverse DCF works backward to show you what growth rate the current stock price is pricing in. For each method and preset, LVI calculates 3 scenarios: a bull case, a base case, and a bear case. Let us look at Alphabet as our case study. To keep things simple, we will use the Analyst projections preset. First, we need to choose the valuation method. We are not using the traditional free cash flow DCF here. Why? Because Alphabet currently has very high capital expenditures for AI. This depresses the current free cash flow, making the starting point artificially low. If we project from that low starting point, we will get unrealistic results. So, the best way is to select the method revenue and free cash flow margin DCF. This starts with Alphabet's revenue and uses estimated free cash flow margins to project future cash flows. Now let us look at what the analysts are expecting. The preset has already loaded the growth rates from the consensus revenue estimates. The bull case is based on the high estimates from analysts, which is 19.6%. The base case uses the average consensus estimate of 17.9%, and the bear case is based on the low estimates, which is 15.72%. Now look at the free cash flow margin. By default, to remain conservative, LVI sets the base FCF margin and exit multiple using the average of Alphabet's performance over the last 10, 5, and 3 years. Specifically, the default baseline starts with a base free cash flow margin of 15.25%. The bear case drops even lower and the bull case adds 2% to it. The default exit multiples are also conservative. The base case starts at Alphabet's lowest historical price to free cash flow average of 26.38 times, which is derived from those same 10, 5, and 3-year historical averages. And with these ultra-conservative defaults, the calculated intrinsic value at the bottom shows bull case of $331.71, giving an 8.6% annual return. Base case of $252.19, giving a 2.9% annual return. And bear case of $184.12, resulting in a negative 3.4 annual percent return. But is our job done here? Is it that simple? No. This is where calculating intrinsic value becomes an art rather than just exact mathematics. Let us look under the hood and try to make sense of these numbers. Since Alphabet's current capital expenditures are high, the current margin of 15.25% is much lower than their historical average. If you look at the last 10 years of Alphabet's metrics, their free cash flow margin has been very consistent in the 21 to 24% range. So let us assume Alphabet's margin normalize as their AI investments starts paying off. We will adjust the base case free cash flow margin to 21%. And if you look at the historical metrics table on the screen, Alphabet's FCF margin has averaged 21.8% over the last 10 years and around 20.7% over the last 3 and 5 years. So 21% is a very realistic normalized baseline for this business. We will then adjust the bull case margin to 24%, assuming they go back to their highest historical margin. And if things do not go well, meaning the massive AI capital expenditures does not yield good returns on investment and instead becomes a permanent drag on their profitability, we will set the bear case margin to 18%. This represents a structural drop below their historical averages. Next, let us look at the exit multiples. As a business matures, its valuation multiples tend to contract. Let us tone these down for 5 years from now. We will set the base case multiple to 22. This is a very reasonable and realistic multiple for a mature, dominant giant like Alphabet that is still growing at a steady pace. We will then set the bull case multiple to 25. If Alphabet's AI initiatives succeed wildly and margins expand, the market will reward them with a premium multiple. And we will set the bear case multiple to 20. If growth slows down to single digits, the market will re-rate the business as a mature, slower growing economy, so 20 times acts as a conservative floor. Look at what happens to the intrinsic value now. Our new base case intrinsic value is $295.91, representing a 6.2% expected annual return. Our bull case is close to $400, representing an 12.8% annual return. And our bear case is $217.78 with a flat return. Now, as an investor, you have to ask yourself a capital allocation question. Is a return profile of 0% to 13% over the next 5 years attractive enough for you to put your new capital to work? What that means is, if based on our understanding of the business and the assumptions we just made, the worst case were to play out, we will not make any money, but if the bull case were to play out, we may make up to 13% annual return. If you already own the stock, does this justify buying more, holding, or looking for better opportunities elsewhere? This is the real work for you as an investor. Below the calculations, LVI gives you a projection chart and a sensitivity analysis table. This sensitivity analysis table shows you how your expected returns change based on your entry price. For example, at the current price of $353.47, our base case expected return is 6.2%. But look at the table. If the stock price drops below 25% to $265, your base case return jumps to 12.5% and your bull case return goes up to 19.5%. This table is incredibly helpful for visualizing the exact price at which you would feel comfortable building a position. And if you are wondering how these final numbers are calculated, you can click on the calculator icon next to any case to open up the step-by-step calculation details. It shows you the year-by-year projections, the discounting, and how the final per share value is reached. Finally, if you want to save this model or share it with other investors for their input, you can click this Save and Share Model button at the top and share the link. For your convenience, I will share this link in the description below. So please do play with the calculator, adjust your assumptions and see how it plays out. Let me know what you think of this valuation tool. Does having this kind of quick interactive analysis add value to your quality value investing workflow? If you have any suggestions on how to make this tool even simpler, leave a comment below. Thanks for watching, and I will see you in the next one. Happy investing.